Liquidity determines survival before returns determine wealth. If you are forced to sell good assets at the wrong time, your strategy is broken, no matter how intelligent it looked on paper. The investment mindset that builds generational wealth begins there. You do not invest to feel clever. You invest to stay solvent, compound consistently, and control risk long enough for time to do the heavy lifting. Your job is not to predict every move. Your job is to build a structure that can survive bad timing, changing regimes, and your own emotions. You need to think about investing as a system of pressure, incentives, and time. Markets are not moved by stories alone. They are moved by cash flow, liquidity, interest rates, volatility, positioning, and the constant repricing of future expectations. Price is what you see. The mechanism underneath is what matters. If you want to build wealth that lasts across generations, you stop reacting to headlines and start reading structure. Here is the operating mechanism in plain language. Markets price assets based on expected future cash flows discounted back to the present. That is the core. When interest rates rise, future cash flows are worth less today, especially for assets that depend on earnings far in the future. When liquidity expands, investors tolerate more risk. Valuations stretch, and weaker businesses can still rise because money is abundant. When liquidity contracts, the market becomes less forgiving. The same asset that looked exciting in easy conditions can get cut in half when capital becomes selective. Now take that one layer deeper. Momentum is the market's short-term force. Cash flow is the business's long-term force. Interest rates set the gravity. Liquidity determines how far prices can deviate from intrinsic value. Volatility reveals stress, uncertainty, and forced repositioning. Positioning tells you whether buyers are already crowded into the same trade. These are the market's internal organs. If you ignore them, you are not investing. You are guessing in a more sophisticated vocabulary. You need strategic reasoning because every investment decision sits inside a context. A high-quality business bought at a reckless valuation is still a bad trade. A mediocre business bought at a distressed but survivable price can outperform if conditions normalize. A broad index fund is a powerful tool when your time horizon is long and your behavior is stable. A concentrated position can be rational only when your edge is real, your size is controlled, and your survival does not depend on being right quickly. That is the difference between investment thinking and investment theater. Most investors misunderstand this because they focus on outcomes instead of process. They see someone make money in a hot market and assume the logic was sound. They confuse a bull market with skill. They treat rising prices as confirmation instead of asking what changed in the underlying mechanism. You cannot build generational wealth that way. Generational wealth is not built by accidental wins. It is built by repeatable decision quality. So here's the mindset shift. You do not begin with the asset. You begin with the time horizon, the liquidity need, and the loss you can survive. Before you buy anything, you decide what role that capital plays. If the money may be needed within 2 years, it should not be taking equity-like risk. If the capital is long-term family capital, then volatility is acceptable, but permanent impairment is not. If the goal is compounding over decades, then your selection process must prioritize durability, not excitement. You are not trying to find the asset that will impress people this year. You are trying to build a structure that future family members inherit with strength rather than fragility. That means you favor assets with productive capacity, understandable economics, and resilience across cycles. You favor businesses or funds linked to real earnings power. You respect cash not because cash is exciting, but because optionality matters. Cash is what lets you act when others are forced to react. Now, make this practical. Start with your portfolio architecture. Your core should be the part that does not require constant brilliance from you. For most people, that means broad diversified equity exposure, tax-efficient accounts, and a liquidity reserve large enough to prevent forced selling. If markets fall 30% and you need cash next month, your asset allocation was wrong before the crash happened. Fix that first. Serious investors do not build from conviction alone. They build from sequence control. When the market is trending higher and liquidity is supportive, you do not suddenly become reckless just because risk is being rewarded. You keep your core intact, add selectively, and refuse to let short-term strength trick you into ignoring valuation and size discipline. If the market is rising on broad participation earnings, revisions are stable, and financial conditions are not tightening aggressively, you can lean constructive. But constructive is not the same as careless. You still define how much of your portfolio belongs in concentrated ideas, how much remains diversified, and how much stays liquid. If the market moves higher, while valuations are expanding faster than cash flow reality, you do not chase simply because price is moving. You reduce your need to be entertained by movement. You ask whether momentum is being driven by improving fundamentals or by multiple expansion fueled by easier conditions and crowd positioning. If it is the second, you either size smaller demand, better entry points, or stay with the core and let others overtrade. That restraint is part of the mindset. If the market falls sharply, your reaction depends on the type of decline. If it is a valuation reset in strong assets without balance sheet stress, you prepare to buy incrementally. If it is a credit event where liquidity is vanishing and weak balance sheets are at risk, you do not rush just because prices are lower. Cheap is not enough. Surviving is the filter. You do not buy falling assets mechanically. You buy improving reward to risk structures. There is a difference. Entry logic matters because most investors confuse an idea with a position. An idea can be excellent and still deserve a small initial entry. A position earns the right to grow when your thesis is being confirmed by fundamentals behavior or both. You can scale into strength when the conditions supporting the thesis are broadening, not merely because you fear missing out. You can scale into weakness only when your time horizon is long, the asset is durable, and your liquidity is secure. You never let a single entry define the whole result unless the opportunity is overwhelming and your downside is precisely understood. Exit logic matters just as much. You do not sell only because you are bored, and you do not hold only because admitting error is emotionally unpleasant. You exit because one of three things happened. The thesis changed, the valuation became unjustifiable relative to probable returns, or the original time frame logic no longer applies. That keeps you from using price alone as your decision maker. Price informs. Thesis decides. Position size is where intelligence becomes discipline. A great thesis with reckless size can destroy years of good work. If an asset can drop 40% without invalidating the long-term story, then your size must be small enough that such a decline does not damage your broader plan. This is where people fail. They find one compelling idea, overestimate their edge, and oversize into uncertainty. You do not build generational wealth by proving conviction through concentration. You build it by staying in the game. Use situational logic. If rates are rising and liquidity is tightening, you reduce dependence on long-duration speculation and focus on assets with current cash flow pricing power or defensive balance sheets. If rates are stabilizing and growth is improving, you can expand risk selectively. If volatility spikes without systemic damage, you use watch lists and stage buying. If volatility spikes with funding stress, you preserve flexibility and avoid pretending that every drawdown is automatically a bargain. Common failures are predictable. Overconfidence makes you size too big after a few wins. Trend chasing makes you enter when the risk-reward is already degraded. Poor risk control makes you average down in assets that are not merely down, but structurally broken. Ignoring timeframes makes you buy long-term assets with short-term money, then panic when short-term pain appears. The market punishes confusion about time more consistently than almost anything else. This is where most people stop, but this is the advanced level. The advanced level is understanding second-order effects. When rates rise, the first-order effect is that expensive assets reprice. The second-order effect is that financing conditions tighten, weaker businesses lose access to cheap capital, consumers slow, and correlations that seem stable begin to change. When liquidity contracts, not only do prices fall, but the market starts distinguishing between inconvenience and insolvency. That distinction is where fortunes are protected or destroyed. You need to study mode changes. Markets do not behave the same way in all environments. In an easy liquidity regime, bad assets can rise with good assets, and trend following looks smarter than it is. In a restrictive regime, correlations can break down, leadership narrows, and narratives stop carrying weak businesses. If you keep using the last regime's playbook in the current regime, you will keep misreading the signals. That is why adaptability matters more than ideological purity. Learn the mathematics of bankruptcy risk. A stock down 50% can recover. A business that cannot refinance its obligations may not. A speculative asset with no cash flow depends on somebody else paying more later. A business with durable free cash flow can survive periods of neglect. The advanced investor distinguishes between volatility risk and terminal risk. Volatility is tolerable. Terminal impairment is not. Generational capital must care much more about the second than the first. Behavioral traps get more sophisticated at this level. You may avoid obvious hype, but still get trapped by intellectual vanity. You may become attached to being early, to being contrarian, or to having a unique view. That is still ego. The market does not reward originality by itself. It rewards correctness adjusted for risk and timing. Sometimes the highest level move is not finding a new angle. It is refusing to invent one when the base rate answer is already strong. Liquidity traps are another advanced problem. Assets can look cheap for a long time when there are no natural buyers, when forced sellers dominate, or when market structure itself becomes stressed. You do not solve that by repeating that value will eventually win. You solve it by controlling size, staggering entries, and refusing to use capital that cannot wait. This is why patient capital outperforms impatient capital over long horizons. It is not just more disciplined, it is structurally advantaged. Now bring it all together into a practice. You do not develop this mindset by passively agreeing with it. You develop it through a process. Before every significant investment, write down the thesis, the time horizon, the expected driver, the invalidation point, the position size, and the conditions under which you would add, reduce, or exit. If you cannot explain the investment in plain language, you do not understand it well enough to size it responsibly. Keep a decision journal, not a performance journal. A decision journal. Record what you saw, what you expected, what mattered most, and what could prove you wrong. Then review it after the outcome. This is how you separate luck from process. You are not trying to become perfect. You are trying to become less self-deceptive. Use reverse testing. Before you buy, ask why this idea might fail, even if the story sounds good. Ask what would happen if rates stay higher, longer, if margins compress, if credit tightens, if the consumer weakens, if the market derates the sector, or if your timing is simply bad. Then ask whether the position size still makes sense. That is not pessimism. That is adult risk analysis. Run simulations mentally and on paper. What happens if your portfolio falls 20%? What happens if your concentrated idea falls 35% while the thesis remains partially intact? What happens if correlations rise and diversification helps less than expected? What happens if you lose income temporarily and need liquidity? Stress testing does not eliminate risk. It prevents surprise from becoming panic. You maintain the skill with evaluation loops. Review your portfolio on a schedule, not every emotional impulse. Measure thesis accuracy, not just returns. Track turnover drawdown behavior, average holding period, realized mistakes, and whether your entries were driven by process or by urgency. The right metrics make you calmer because they shift your attention from noise to structure. Combine this mindset with other tools properly. Valuation tells you what you are paying. Macroeconomics tells you what the environment is rewarding or punishing. Technical analysis can help you read behavior trend and liquidity conditions, but it should not replace balance sheet logic or cash flow analysis. Risk management tells you whether you can survive being wrong. None of these tools is sufficient alone. Together, they create a stronger decision framework. And test this skill under pressure before trusting it with large money. Use virtual trading to rehearse execution and journaling. Use small-scale real positions to test whether your psychology matches your theory. Perform pre-trade risk analysis before every meaningful move. Ask what the position does to total portfolio risk, not just what it might make if things go right. Learn how your body reacts to drawdowns before the stakes become large enough to distort your behavior. If you do this well, your mindset changes in a visible way. You stop confusing movement with progress. You stop needing constant action to feel in control. You stop asking whether an asset is exciting and start asking whether it is useful in your architecture. You begin to see investing not as predation, but as structured capital allocation under uncertainty. That is the mindset that builds generational wealth. Not heroic certainty, not permanent aggressiveness, not elegant macro commentary without execution discipline. It is controlled allocation, repeated under changing conditions, with enough humility to adapt and enough discipline to stay consistent. And if you review this carefully, notice the small detail holding the whole logic together. Every major decision begins before the purchase, not after it. That is usually the part worth reading twice.